Hello, everyone. My name is Jennifer Maxwell with Maxwell Healthcare Associates. I'm very excited to start our first of a part series in regards to M&A and the future of it. And I am excited as well to introduce our panelists this week. But before I do that, I want you to understand the full value of this series is to provide you all with a thorough understanding of the current M&A landscape, also help evaluate assets with our expert advisors here on the panel today, and how to leverage technology and data to prepare for the future of home health and the hospice M&A space. So thank you all for joining us today. We're very excited. Just a little logistics. Everybody is on mute as you were told. Also, if you have questions throughout the webinar, we do have 15 minutes or so towards the end of this webinar for you to ask some questions. So if you think of it, please put it in the chat during this webinar and we will make sure to try to get to those by the end. So thank you. Well, as I said, this is the first of a three-part series. This is navigating the M&A space, some key trends and the role of the advisors. Today with me, I have Cory Mertz from Mertz Taggart and Jay Duty from Maxwell Healthcare Associates. Cory, could you please introduce yourself and give a little bit of background?
Sure. Thanks, Jennifer. As Jennifer mentioned, I'm Cory Mertz. I'm a managing partner with Mertz Taggart. Mertz Taggart we're a healthcare services mergers and acquisitions firm. We specialize in the lower middle market, and for us, that includes companies that typically have an enterprise value of somewhere between $3 million and $100 million, and really everything in between. That's kind of our sweet spot where we typically add the most value to our clients who are typically sellers. We started in 2014 as a company. Been doing M&A longer than that, but as a company, we started in 2014, so coming up on our 10-year anniversary. And as a company, I think we've done right around 85 transactions for a total enterprise value of somewhere around $1.3 billion.
Great, thank you. Jay, tell us a little bit about you.
Sure, thanks, Jen. Jay, the Chief Operating Officer at Maxwell Healthcare Associates. My background has been in the provider space, doing Chief Corporate Development Officer work in the M&A space and strategy before that. The first iteration of my career was actually in hospital administration, working for HCA, but I'm excited today to be a part of this discussion. Cory and I have actually been involved in these discussions on the provider and investment banker side, doing deals together. So I'm going to enjoy this conversation a lot. We are a consulting services firm that is now tech-enabled, and so we are Maxwell Healthcare Associates provides implementation services of EMRs and technology of any kind. We do assessment and optimization work to look at home health and hospice agencies and their operations and how efficiently they run. We do a lot of work around business analytics, and we actually have our own tech-enabled services and 4 products live today that we are now inculcating in our consulting services. So excited to have this conversation today, and thanks for having me.
Great. Thank you guys for introducing yourselves. Well, let's dive right in, as we only have a full hour here, and there's a lot of really great information and insights that I hope you guys are excited to hear just as much as I am. So let's start with Jay. We'll ping back and forth between the two of them. But Jay, let's start with you. Can you share with me your perspectives on what makes this webinar series relevant to leaders in the home health and hospice industry today?
Yeah, I appreciate that. Yeah, I think there's a lot of activity going on right now. So I think now is the time. We're seeing on the consulting services side, more and more on the buy and sell side of working towards getting those assets ready to go to market or preparing them once they do go to market and integrating those together. So I think this is relevant now because we're seeing a lot of activity starting to kick up. And I know Cory's going to talk a little bit about that, what's up and coming. So I think that's important. I think there's a lot of, used to be that you would just acquire assets for locations and just grow. We've seen a lot more scrutiny, both on the clinical and financial due diligence side of the quality of that asset. And so I think it's really important to have the right advisors when you're going to do this deal, if you're on the sell or buy side, to take a look at that asset and just see what the quality of that asset really is under the hood and deep down, as opposed to just growth for growth's sake. So I think that makes it relevant. I think this is really important today to talk about how you work together with a seller as a consulting firm, investment banker, seller buyer to make sure that we're really transparent and looking deeply into what that asset really holds for the market.
All right, thanks, Jay. Cory, can you give us your perspectives?
Yeah, I think for us, our hope is that it's educational. Especially I would say just because we typically work with sellers who are owners of these companies. Really hope it's educational for the owners who are out there. My hope is whether you're looking to sell 6 months from now or 10 years from now. Maybe you'll get a nugget or two of good information that will ultimately help you, get the very best deal that you can out there, and perhaps maximize your enterprise value.
Love it. Thank you. So our second question is kind of looking at the industry landscape overview. Cory, I'd like to start with you. From your vantage point, what do you feel are the most pressing, challenges currently facing our industry today?
Yeah, great question. And I think to answer this, I would want to perhaps we can pull up the graphs.
Perfect.
Is that available? If not, no big deal. But yeah, so it's kind of a two-part answer. If you're looking at, what's happening, what are the most pressing challenges facing our industry from an M&A perspective? I think it's helpful just to kind of look at where we've been, because a lot of where we've been is really dictated where we are now. And so if you look at where we've been, over the last 5 years, we're really at what I believe to be the tail end of a 5-year cycle, which really started, when COVID hit, right? Things were pretty normal until mid-March of 20. What was it? Now I'm losing track. 2020.
2020.
Yeah, and then all of a sudden, everyone panicked, rightfully so. But the whole world shut down, including M&A, certainly no exception there. Folks were just trying to figure out what's going to happen. Is from an investment perspective, does it still make sense to invest in anything right now, given the environment? So things shut down for about, I was going to say 5 minutes. It felt like 5 minutes. It was about a month or two. And so we had a really slow quarter. Q2 of 2020 was very slow. It's not showing on this slide, but that was the quarter that got affected. And then from there, it's just been, it was gangbusters for a couple of years. You'll see that, from 2020 through really early 2022, we were seeing anywhere between 30 and almost 60 transactions a quarter. So what had happened, was once everything shut down, the government intervened, right? And they did a couple of things. Number one, they dumped a ton of money into the economy, and we can talk more about that in just a second. But the Federal Reserve basically lowered interest rates to zero in an effort to stimulate the economy. And it was effective, especially in the M&A world. So what happened at that point in time? Now we're talking, third quarter 2020, deals are back on again. Buyers are able to acquire companies, with very low, historically low interest rates. And they've got a ton of money to invest. Some of you have probably heard of the $1 trillion in dry powder that U.S. private equity has and has had. They continue to have that, and they're looking for opportunities to invest. But so that was a perfect opportunity for them to invest, and we saw that bubble. We saw that bubble form. For sellers, the motivation was really threefold, right? A lot of folks were burned out. Didn't take long to get burned out with COVID. That was tough, especially as an owner. Valuations were at an all-time high, so it was a good time to sell. And then some of you may or may not remember, we had a proposed change and then a change in administration, and there was a risk that the capital gains tax rates were going to go up from 20% to 40%. And so a lot of sellers headed for the exits, trying to sell in advance of that capital gains tax rate going up. So that's what motivated the sellers. I mentioned what motivated the buyers. What was particularly interesting about home-based care was it was still investable from a healthcare services perspective. A lot of facilities-based companies, they were not investable for a period of time. So a little bit more of a catalyst. So that carried us through early 2022, and you may recall the stimulus dollars that the Fed injected into the economy. I can't remember the number now, but it was in the trillions, $4 to $5 trillion. In my opinion, that was a big contributor to inflation. Inflation went out of control, far exceeded the rates that the Federal Reserve has pegged, which is typically 2%. I don't have the numbers, but in front of me, but they were significantly. So the Federal Reserve had to jump in and immediately raise interest rates. They did so in historically fast fashion. So the Federal Reserve rate went from 0 to I think 5.5%. Over a series of cuts, one cut after another. That had the impact of lowering inflation, slowing down the economy, slowing down deals. Capital became harder to get. It became more expensive. Buyers had to get a lot more selective. It was very difficult to get transactions done, from late 2022 to really, early 2024. What also caused that, by the way, buyers were still interested. There was still plenty of demand, but a lot of the quality companies, the companies that kind of check all the boxes, and we'll talk more about that, I know, in a bit, they sold in 2021 to 2022. So there's been kind of a dearth of quality opportunities out there for buyers to really sink their teeth into. So that's another part of what's kind of caused the slowdown there. Good news is, the Federal Reserve began hinting that they were going to, since they were getting close to bringing inflation down to the 2% target, they've started to hint at the reduction in the rates. They have since they had their first rate cut. They announced their first rate cut just a couple weeks ago, and we expect to see a series of rate cuts. What that has done is that has caused bank rates to come down already. It's caused buyers to have more access to capital. And what has happened is that has caused a lot of these would-be portfolio companies, these would-be sellers, these portfolio companies that are owned by private equity, they haven't been able to sell for the last couple of years because they haven't been able to get the value that they're looking for. Now that a lot of these guys are looking at an exit, late 2024, 2025, I think we're going to see more portfolio company exits, which will likely produce more lower middle market transactions. And I know I just said a lot there.
No, that was great. I mean, thank you for the overview of that. Jay, do you have anything to add to that?
Yeah, I think definitely there's a glut of buildup and folks that are looking to transact now based on those changes in the economy. I think the inflationary pressures have only highlighted the workforce shortage and pressures on the workforce too. I think that's what we're seeing is how do people do more with less? How do they get really lean to provide the same quality care, but make sure that we got caregivers in front of the patients to take care of them too. So even with a raise in proposed, in home health last year, that really didn't keep up with the inflationary pressures on what it's costing agencies to put gas in cars of a mobile workforce, pay for these clinical assets that are hard to find, quality ones as we work towards a workforce shortage there. So a lot of really streamlining, centralizing certain functions there, optimizing, making sure the back office function within an agency is really supporting the clinical care that's being given in the home. And so I think there's some opportunities there, and agencies are really looking into how do I optimize the people side, the process side, and the technology side of my business to provide that same quality care, keep the quality up, keep the delivery more efficient. And so that's what we're seeing that we're clamoring for. A lot of our work has been in how do I get more efficient intake in taking those patients, scheduling those patients? How do I do things with my data to understand those operational indicators and efficiencies that I can gain too? And so that's what we're seeing. And with that pressure on the workforce, with costs going up, agencies are really having to discover if I'm going to look at an asset, I need to know that that's something that I can fold into and integrate into my current operation, and really be strategic about that, and how that the bringing of agency A and agency B together, how do I smooth out that process? So, I'm really excited to see that that's moving again, and I'm really interested to see, how interested, like we've seen in the past, getting that quality asset, but also getting one that's operationally efficient. Like, how do we look under the hood and figure out, the best way to bring those two organizations together?
Thanks, Jay. So before we move on, one comment from Cory's position. It's interesting that you mentioned about private equity and the portfolio exits. Investors that invest in the funds within those portfolios. 3 to 4 years is kind of when the turn needs to happen. Now we're sitting at 5 to 6, and investors are getting a little angry because their money's been tied up, and they could put it in this market or they could put it elsewhere. So that's a great comment that you made, that because we're starting to hear that. We work with a lot of firms, and there's a lot of angst to kind of get things moving. And then just a quick follow-up question. You talked about the capital gains, the 40 to 60%. That's still looming out there. Do you think that potentially will impact depending on, and if so, when do you think you would see that hit again?
Yeah, yeah. So just to clarify, I may have misspoke. So we're currently at 20. The
Or
risk
20 to
was,
40, you're right.
yeah,
Yes.
we were going to go to 40,
Yep.
and then that died down, over the last couple of years. I believe, and I don't want to. I hope I don't come
We're not
across
into
as being
politics itself,
political,
but
but I think the Harris administration has already let it be known that they intend to go back to that capital gains tax rate and do something with it. It doesn't sound quite as as extreme as it was originally proposed by the Biden administration, but I think they're targeting somewhere around 30%. So that could certainly impact things, especially. So there's a target rate, right? And who knows how long that might take to ultimately
exactly.
get implemented. So if something like that were to get implemented January 1st, 2025, which could happen, my guess is sellers are going to be less likely to want to sell for the next year or two. They're going to because they don't want to they want to make up for that difference, right? If they set a target for January 1st, 2026, and the Harris administration ultimately goes into office, then that will probably accelerate a lot of exits over the next over the course of 2025. So it's going to be interesting to watch and see how it evolves, if nothing else. But if history is any indicator, it will likely have an impact.
Yeah, thanks. Not to send that off to a tangent, but I think that's important to know too, because we do have, an election coming up. There's, portfolios that have been on hold. There's a bunch of, factors that are taking place that, to tease out where it's going to be has been somewhat of a challenge on everybody's part. So thank you both for that. So let's move on. And if we were to see, how do you see like consolidation impacting the competition and the opportunities in the market? Cory, let's start off with you.
Yeah. So how do we see consolidation impacting competition? So what we have seen is again, it's an evolution, just like everything is. So if you look at what was going on 5 to 10 years ago, right? A lot of these strategic buyers who were the public companies ultimately were consolidating. They all wanted to build out the continuum, right? This was something, but it was for a different reason. They wanted to target a geography and then basically have as much control over that patient or a client population as they can. But it was in an effort to really, capture the most from those patients from a referral perspective and being able to capture, regardless of the need, service those patients in their homes. And that was always the motivator up until just a few years ago when the payers started getting involved in doing acquisitions, right? Now we've seen both Humana and United via Optum become basically the ultimate consolidators, right? And the guys below that, in this case, some of the publicly traded companies and the larger portfolio-based companies, they still kind of have a very similar desire, which is to build out the continuum, but it's for a different reason now than it was. It wasn't just to capture that patient population and get referrals. Now it's all about value-based care, and don't know how long this will continue, the value-based movement. I think it's got some traction. I know there's some debate out there, but that's really changed. That's changed the entire landscape, and buyers, and I should say, and sellers, portfolio companies, and their strategies.
Makes sense. Jay, how about you? What do you see consolidation and how that's going to impact competition and opportunities?
Yeah, I think the pressures to grow have driven a lot of that for consolidation. I think that, as Cory mentioned, as more and more Medicare beneficiaries become MA beneficiaries, you've seen those pressures on kind of that traditional Medicare business that's kind of been the bread and butter of the industry. You get some pressure put downward pressure on that. And so as they look to grow, consolidation is still happening, that, a lot of these regional players get a little bit bigger. I think and we'll talk about kind of what strategic buyers doing a little bit, but I think the idea is, how do you grow? Do you grow in your current footprint? That same store growth has been tough for providers. And so what do you do whenever you figure out how aggressively to go into the MA space? Some of that business is out there for the taking, but you've also got to figure out how that fits on your platform, how you incentivize sales folks to get out there and get that business. And so as we see that, the idea of just same store growth has had so much pressure on it. To get bigger, typically those providers have had to go outside of their space too. And again, as Cory mentioned, the idea of the payvider, where a provider and a payer are one and the same, that's a different model to have to compete with for some of these strategic folks that are looking to grow. So I think the consolidation will still happen. You've seen a lot of big pieces get gobbled up by others. But there's still some large regional players out there that are really, really strong in operations and growth, but they're looking at how do they get that just a little bit step bigger, and how are they going to grow.
You mentioned something really good right there, which helps us kind of twist into our M&A trends. You talked about strategic buyers. Jay, I know you've been in that position. Tell us a little bit about what you've experienced in the past and what you're kind of seeing now, even though you're kind of in a different role.
Yeah, I think, it's really that idea of a quality asset and the definition of that. Strategic buyers, let's face it, at one point it was like buy dots on a map, get bigger geography, go acquire something, we'll integrate it with ourselves, we'll fix it, we'll kind of bring them under our umbrella and into the fold, and everything's going to be great. We've seen people be a little more choosy in the asset that they're going to go acquire. So strategic buyers are looking to align it with their existing operations, whether that be geographically. I think the other kind of mindset that they have is maybe that's about service line overlap. Where am I strong in home health today that I could overlap hospice and grow that footprint where one can build the other? Where does personal care kind of fit into that mix to support the other service lines, like home care to hospice? You've heard some of the larger players kind of mention that very publicly as their strategy is, hey, we're going after this service line to overlap with that service line, because that's how they think they can grow internally. And a certain number of those patients that are home health today maybe become hospice. Potentially your personal care services support the hospice. And so there's really deliberate strategies on that, and how they're going to grow versus just, hey, we're going to get bigger here and there. So it may be adjacent to a footprint. It may be into an entire new region of the company that they feel like they've got a large enough platform that they can replicate that across the country in different locations. And so I think they've got to not only do that to grow, but how are you going to do that efficiently? How do I appropriately get operationally efficient as I get bigger in scale into those markets? And so they're being a little more choosy, and we've actually seen more deals getting kicked out of the process for things like a quality review, where it might have been like, hey, we'll take that into consideration, but we're going to just build that in our platform and we'll fix it. Now it's like, we may not want to do that transaction because of what Cory mentioned, value-based care, or just the quality of that asset. Of course, now in home health for sure, that the patient satisfaction and quality of that care is now driving financial performance as well. And so that's really more valuable today than it ever has been. So I think that providers are going to have to look for those quality assets, whether that's financially solid, asset that's also got really good clinical care on that quality side, and how sound are their processes whenever they're, intaking a patient. Do they have a good way to convert that admission into a referral? What business does that lead to? How much are they reserting patients? Those kind of things are all factors now that people are looking a little bit deeper as a dive than maybe traditionally that I've seen in the M&A space. So I think to summate that, strategic buyers are looking to be very choosy, but there's been this pent up demand, so perhaps there are some of those transactions out there to have. And so I think there's more and more scrutiny on those, and I think that's why I think we need to talk to, and we'll get to this a little bit later, but working together with an investment banker or broker, somebody like a consulting services firm that can really take a look at the true picture of that asset, clinically, financially, and operationally, and make sure that it's really, really sound.
Thank you. Thank you. So, and then Cory, taking that with the strategic buyers component that Jay just expressed about, tell us how that plus private equity interest in the sector, and what implications do you see for organizations that are trying to grow right now?
Yeah. Jay's right on. In terms of what's going on out there with the strategic buyers, right? And even look, private equity is, they're just going to follow what the other successful private equity guys have done, right? So you don't see a lot of unique models out there, but choosy is a good word. I would say, as Jay mentioned, it used to be just kind of land grab, give us everything home health and hospice in these states, and we'll buy them, we'll pair them together, and I shouldn't say pair them together. We'll have both service lines, and have kind of a little bit of a continuum. Buyers have gotten much more choosy, not only about the quality of the company. I mentioned there's just not a lot of quality opportunities out there right now, and that's really driven the volume as much as anything. But so not only have they gotten more choosy about what they're willing to really pay for or go after, but the strategies have changed too. They've become much more focused. So before, if a buyer would have said, hey, give us any hospice, find us any hospice in Texas, or the Southwest. Now they might say, we want hospices in the major markets in Texas right now, and we just want to expand on that. So they're going deeper, as Jay mentioned. What we're seeing at a high level is really trying to capture the patient population, or provide the continuum of care in the markets, but on a much larger scale than they used to. And that gives them the opportunity, especially on a personal care level, to collect data and outcomes information, and hopefully get to enough scale that they can have a seat at the table with those payers. ACOs, Medicaid MCOs, Medicare Advantage plans. So they're really trying to capture as much of the patient population in the areas that they service. They're doing home health, hospice, home care, 2 of the 3 legs, typically, maybe 3 of the 3. But a lot of these guys have also added other services, including infusion services, physician at-home services, which is typically hard to make money on a standalone basis. But if you wrap it into a value-based care contract with with one of the payers out there, it can be a nice business for you.
Thank you. It's interesting you say that. Yeah, we're seeing that too on our end, with kind of the footprint component being there, but it's more strategic, right? So with that, and then the data of patient outcomes, and how do you have that seat at the table with the payers is a big deal. When we're looking at, evaluation metrics, you'd mentioned it earlier on, Cory and Jay, that like we were getting numbers that historically we'd never seen before. How do leaders prioritize that when considering M&A opportunities today? Jay, do you want to start that one?
Yeah, I think, and I'll kind of piggyback off what we were talking about. It really has to do with, the aspects that people look into in these organizations are very unique to the market, right? So it can't just be a one size fits all. You're not going to get, when you're buying a bunch of different markets in a large acquisition, there are those ACOs you have to take into account, the payer landscape, what that looks like. I think it's still about margin and EBITDA multiples. Cory may have a different perspective on this, but I think it's some factor of, certainly not top line revenue. I think it's how that you're able to efficiently operate. EBITDA multiples would be one of the biggest one. The patient census growth and that trajectory, I think, is a key driver for that. I mean, you can boil it down to a lot of other pieces, and we need to dig deep and look at it. But those kind of things kind of are good indicators of how that asset is being managed there too. And you want to see the growth. You want to see that you're in markets where there's perspective of patient buckets in both the payer space, the traditional Medicare space, what ACOs and value-based care models are in that specific market to grow too, because it's really unique and specific to that local healthcare market, depending on the size of all of that. So you have to look at all those pieces and how they look together, and it may look completely different in, say, Birmingham, Alabama, than it does in Tampa, Florida, or in Idaho Falls, Idaho. You have to kind of look and see individually where those markets are too. And I think the drivers of what that looks like still boil down to how efficiently are they operating that asset. So that's what I would, if looking for a specific answer, and that's what people always want to ask, right, Cory? Like they want to know what are the multiples out there and what should we be looking at? I remember people always used to kind of try to pull me off sides to kind of say what I was looking for, but it's about the tight operation of that asset and then how are they growing in that census.
Cory,
Yeah,
tell us your
yeah.
thoughts.
I'm sorry. Yeah, I agree with you, Jay. If you look at financial metrics, just starting, so there's two types: financial metrics and operational metrics, right? If you're looking at the financial metrics, yeah, I mean, EBITDA is super important. That's the basis of the valuation when you apply the multiple, which we'll talk about. But it's also very much about margin structure, financial margin structure, right? So, what are your gross margins? What is your overhead? What is your bottom line net margins? And there's no short answer to what that should be. It really depends on the company. It depends on the geography for sure. It depends on the payer. And so I think it's always important as a seller to really understand, kind of what are the benchmarks, the financial metrics benchmarks. And again, I'm talking about gross margin, adjusted EBITDA margin. What should they be? What should we be striving for? Because if you can kind of dial in that kind of, that target margin, you're more than likely going to get a premium multiple being applied to that. If your margins are not correct, buyers are going to look at it and say either, that's not sustainable. Well, they'll probably look at it and say that's not sustainable. So we just can't pay the same kind of multiple that we typically.
Yeah. Well, thank you. So as we, think about that, the margins and efficiency, we've been talking about efficiencies and, the use of, streamlining people, process, and technology. Cory, what do you feel the role of consulting firms in preparing organizations for a successful M&A transaction?
Yes, super important. We rely on consulting firms very much like Maxwell a lot of times as we develop relationships with sellers, right? Whether they're ready to sell in 6 months or again 10 years from now. It's a long sales cycle. But one of the things that we do is we like to we haven't formalized this yet exactly, but we have what we call a value accelerator program, and it's basically connecting with the seller early on, looking at their numbers, looking at their operations, looking at their margin structure, looking at their operational metrics, and coming up with an opinion of value, based on how they're performing today. We may not we may look at the company and say, we think this is a company that's worth 5 million. And that seller says, well, that's great. We've got some work to do. We really want to get 10 million, but we've got some time, so how do we get from 5 million to 10 million, right? And we can provide that guidance to some extent. We can point them in the right direction. But we don't have the depth of knowledge that a Maxwell does. So, once we kind of identify what we believe to be the areas of opportunity, we just think it's super important for them to reach out to and connect with a consulting firm that can kind of help them dial in those numbers.
Absolutely. Thank you. Jay, you're actually in it deep. What are you seeing from your chief operating hat at Maxwell Healthcare Associates?
Yeah, no, thanks for that. I think it's really about diving deep into those operations. So what expertise can we provide from a subject matter, of the deep back office work, of all the processes, operational processes within that agency to make sure that it's ready to go to market. So on the sell side, we actually do an agency health check. We'll go take a look under the hood, much like you'd have an assessment done in consulting services. We'll take a look at not only the value of that asset and what quality is of that asset, reviewing charts, some of those things that have traditionally been done, but really how tight are the operations? What are your processes that around your revenue cycle management? How much do you have left hanging out of there and unbilled that potentially could be optimized? How do your intake, your scheduling process, how are those optimized? And honestly, that's where a lot of the work kind of has been done is really taking in a referral and working it through your process to get that patient on service so that you can give them really good care is a big piece of that as well. So we're excited about that work. We've seen a lot of, the clinical diligence side obviously is something that people are really wanting to take a deep dive in. We had a client who, after taking a look and validating some things, they were actually doing a really great job with their clinical care. They wanted to be able to go deeper to show that, right? And so they asked us to look at more and more charts and really making sure that we were able to validate that the quality of the care they were providing, the quality of the documentation, in their system was really what they had been seeing, over time, and really valuing that asset. So I think working with the consulting firm, really driving up that value early. We've been involved in conversations to say, like, maybe we're not going to market today. Maybe there are some things that we're going to optimize on the operational side, potentially on the financial side, how we're billing and posting claims, maybe it's a clinical piece or a quality piece before we take that to market. To Cory's point, that may linger, for a long time. We may go maybe an 18-month cycle there too. So how do we, shore up anything we can to really make that attractive to bring the value to the market where that multiple then goes up, on being able to assure that your operations are really, really tight too. So that expertise is invaluable for whether it be private equity or strategic buyers.
Yeah, and I'll add to that seal of approval, if you will, right, from a Maxwell doing an agency health check, a billing audit, whatever it might be, with an industry consultant that has a strong reputation, that will go a long way in the marketplace with the buyers. And I think we've talked about this in the past, right? I mean, you come in with that seal of approval from Maxwell, you're gonna get more. You're gonna ultimately get more because buyers, when they make an offer, a letter of intent, they don't know what they don't know yet, right? They still don't know what the outcome of this is going to be. So, they will probably reserve from making their absolute best offer because they just don't know what they don't know yet. If you have that confidence and that security of a health check, you're going to be willing to pay a little bit more because deal certainty goes up.
For sure. And Cory, I think also whenever you work together, you're really able to look at, really be much more strategic about what is the data showing us, like who are the possible buyers? That's the other thing. If on the sell side, you may be prospecting people that are, hey, here's people that might be interested in us because of geographic location, or it just makes sense that they have the size to do that too. So I think part of also maximizing the value is really that strategic side of what kind of seller or what kind of asset am I that a buyer is going to be attracted to. So, having those conversations, I think helps, kind of smooth out that process and really actually shorten the deal cycle too. I think that's another kind of valuable way you work together. When you're answering a lot of those questions up front, then you're not, a buyer is not going to have to spend as much time in a deep due diligence process if they've got a lot of the answers and transparency of what that asset looks like in the beginning, from a data standpoint. And that's where I think there's a really good synergy of working together with bankers, firms, buyers, and sellers to take a look at like how quickly we're all looking for the same information to make an assessment and evaluation of that. How quickly do we get to that information so that we can make decisions and really bring that speed to the deal time, up a lot. There's a lot of, waiting in a diligence process that I think can be handled up front.
That's very good. And one of the other things that we've noticed too, and Cory, maybe you can speak a little bit to this, is sellers, to your point, sometimes think that they're doing really, really, really well. And I know that that's, you guys have, and other firms that we work with on the sell side are like, hey, let's just check it out. Let's litmus test what you think. And and I know that in the past there's been a lot of resistance to, spending some money up front to get money on the backside. Can you talk a little bit about that strategy and what the payoffs could actually be in comparison to just, putting the book out versus stepping back, making sure that they're right about what they're going to bring to market? I'd love to hear your take on that.
Oh boy, yeah, I could go on forever on that part of it. Where do I start? Certainly, where do I start with this one, Jennifer?
I guess where I'm heading is that we've been working, with sell side bankers and that in the past, and being able to say, hey, if you spend X up front, just to see what's going to happen, or where you're really landed from a quality standpoint, from an asset value standpoint, because I'm just going to throw out numbers. What a $50 million company yesterday, or back in the hot times, was getting a hospice could get up to 16 to 18 multiples. Well, it could be just as best of an asset, but they're not going to get 16 to 18 multiples. And so, leveling out the reality of the financial landscape, even though the banking industry is opening up and allowing for more debt asset types of purchases, there's still that little bit of hesitancy and resistancy. What could you tell, like, those that are listening today, that the value of doing that up front versus waiting till you're already down the rabbit hole and may not get what you want?
Yeah. Well, so certainly there is financial benefit, right? If you talk about a company, and I mentioned I gave some half turn, benefit in what they might ultimately get, from a transaction perspective. So if you look at a let's just say you've got a $20 million revenue home health company that seems to check all the boxes, but and I'm just pulling numbers up out right now, but and that company's, let's just say they're doing 4 million in EBITDA, right? Which is not unusual for let's just say a home health company doing 20 million in revenue. We would strongly recommend that they talk with somebody like a Maxwell and again get that health check. I'm not going to tell them how much it's going to cost, but I can tell you that it's going to pale in comparison to the benefit that they get. So I mentioned a half a turn or a turn more, right? Going to market with something like this, you're talking about $2 million to $4 million in actual benefit, right? So probably worth the investment, regardless of size, right? That's I just came up with that number. It doesn't really matter the size. The other part of that is, going through a transaction process is hard. It's really hard. Due diligence is difficult. Nobody wants to go through it twice. And so, part of our job is to make sure that the company is ready to go to market and is suitable and do everything we can to mitigate any kind of surprises that could pop up, during the process, right? So, we talked about the agency health check from our perspective, right? We want to make sure that the financials are on an accrual basis based on date of service. We've thoroughly, looked at anything that may pop up during due diligence that could cause a buyer pause. And so, you get 2 or 3 months into a process and the buyer discovers, they finally complete their clinical due diligence and they find that you've got a 25% billing error rate, which, that could cause the whole deal to fall apart.
Yeah.
Then you're left. I don't want to say you're a tainted asset. That's not the case. I mean, but you're going to have to get it cleaned up, and it's going to take time before you're ready to go back out to market again. So.
Yeah.
Well, and like to your point, it's that deal fatigue after it's all said and done too, right? You've got your management team that's tied up in, trying to do the transaction versus grow the business. So I think it's almost like a double whammy hit if you think about it. There's the having to go back through it again, but then there's the lack of focus on just natural organic growth of the organization itself prior to the deal transaction. And so they're almost, hurting themselves twice by not preempting those things. Jay, do you have anything to add to that?
Yeah. Just to reiterate what Cory said too, whenever I was on the buy side and Cory was representing the sell side, and I remember we pretty much apologized to them like, hey, this is going to be tough. We're going to ask for tons of data. We're going to dig very deep. It's a painful process to get that visibility in there too. And you don't want to go into that process and prolong it because you don't know that information up front. So I think that's where we really kind of where our heads were on this sell side, piece there too. And of course, we can do the agency health check. We can also go do a financial health overview where we specifically have a product. We go in and kind of look and make sure, billing is happening properly. Your revenue cycle pieces are there, your AR, your supply costs, those kind of things. We can look at that financial side and of course a clinical due diligence audit, those things. And we incorporate that in the agency health check too, alongside with once we get to the point we can do the full clinical, financial, operational due diligence there as well, short of we don't do Q of E. Looking at that financial side, we'd advise people to do that in another firm, but we would come into that, full operational view of all of those things. And so, yeah, I think that's why it's important to look at the beginning. And, then we also, obviously we want to get there and involved with that seller early because we may also be involved in integrating the buyer and the seller once they transact as well. And so really being along that life cycle of we're looking at the asset before it sells or helping with the diligence to make sure we're doing that deep dive in clinical, financial, and operational efficiencies there as well. And then integrating those two cultures together, integrating, two systems together, people together, all of those different drivers, the technologies and those processes, may be different. So how do we bring those together and manage the change that happens once that buyer transacts too? So it's a process. It's definitely a process. And so, I think with the more scrutiny put on these deals, the more potential there is for that fatigue to happen for sure.
Great. Well, we've talked a lot today about a lot of, from our landscape, from pre-pandemic time to where we are today. I think we've talked about some really great things such as, the quality of the asset, doing things going to market, as well as being, nimble in the space at looking at quality or efficiencies versus just, continuum of care and or, as Jay said earlier, dots on a map. I think it's going to be a very interesting landscape over the next, quarter to a year from now, because I think that's when we're going to see it all shake loose. And there's been a couple of very large deals that have been sitting, and I think the industry is waiting to see how that shakes out at the end, because I think that too, in and of itself, is going to make a big impression, and I think people all start moving. It's just kind of my gut on that. But with all that said, what would the two of you say are the key takeaways that organizations should consider as they navigate it in our industry? Cory, you want to start?
Yeah, sure. So, I would say a couple things, right? It's better to if you're considering a potential exit, the best I'll quote one of my friends in the industry who says, the best time to start planning is yesterday, right? It's never too early to start planning, whether you're looking to do something again 6 months or 10 years from now. And self-serving as it may sound, we believe that engaging, just building a relationship, right, with an investment banker or M&A firm, and a consultant as early as possible, the better, right? And there's a couple reasons for that. First of all, we can help you plan your exit, and we've done a pretty good job working with sellers, and quite frankly, the sellers that we've worked with, our best clients have been clients that we've known for years, right? And we've talked to for years, and we gave them early guidance. They built the agency. We didn't do much, but they built the agency and made it ready to go to market, and we ultimately got the right deal for them. So as self-serving as that may sound, but beyond that, I think one of the key roles of an M&A advisor in any market, right, especially in today's market, is to give honest guidance, right, on what the company could ultimately fetch in the marketplace. I've heard too many examples of I hate to say this, sellers or owners being kind of baited by M&A advisors and in some cases buyers with a really lofty multiple valuation number. Then they went to market in some cases or got into a deal, and the deal that they ultimately got or the deal that they ultimately walked away from was significantly lower than what they originally intended. And they hadn't done the planning. They reacted to what they thought was a good offer and went down that road and spent considerable time and money trying to get a deal a deal done, only to get it kind of swept out from under them.
Jay, your thoughts on that?
Yeah, it's one of those. Since we're quoting Cory, I would say first know thyself, right? So understand your unique. If you're on the sell side, understand your unique value proposition and who you are and what that quality looks like in the market position that you have when you go to market. And I think that's where you really engage early in the process so that you're ready to go to market. And really the same thing on the sell side. I mean, if you're going to need to apply that scrutiny, do it as if that asset is going to be joining you very, very soon, because they are. And so, think about the integration of those assets as you buy them. And so when you're looking through the diligence process, bring that through to, hey, at the end of the day, the goal is to bring those two organizations together. So how do we do that? And so I think that's where the information and the data, the deeper dive you can do, the earlier, as soon as possible, really drives, that deal time to good. So I would say, you've got two trusted, resources here on the phone. You need to be really bringing others in, and investment bankers can really help you determine that value and be really honest about what that's going to look like going to market. And I think as we see those deals coming through to the back half of this year and certainly the first half of next year, I think that's going to be a time that others will start looking at, hey, I need to start taking a look at when is the appropriate time too. So appreciate the conversation and appreciate the partnership there and talking about how everybody just works together because those deals are going to happen, and whether buy side or sell side, everybody needs to be transparently looking at the same information and make good solid decisions about quality assets.
That's great. That's great. We have about 5 minutes left, five and a half, 6 minutes left of our time here. If there's anybody out in the audience that has any, burning questions for Jay or Cory or myself before we close out this series 1 of our M&A webinar series, please feel free to put them in the question area. If not, and you think of it later, please feel free to email one of ourselves. I believe there's an email. We will be sending out a takeaway with you all with a little bit about Mertz Taggart as well as Maxwell Healthcare Associates as it relates to the M&A services that are provided by both organizations. All right. Well, it looks as though you two have been able to provide a wealth of knowledge to the listeners today. We're super excited, like I said, for this first series, and we look forward to hearing you both in series number 2. So thank you all for listening today. This is Mertz Taggart and Maxwell Healthcare Associates as it relates to the M&A landscape. Thank you.
Thank you.